Welcome to the Shakespeare Wealth Management investment presentation. I'm Kevin Reardon. Let's learn a little bit about the history of the markets and disciplines we can use to invest wisely. We're going to cover various components here in our webinar. First, we'll look at market timing and explain really that it's an impossible way to invest. We'll talk about efficient markets, diversification, and asset allocation, as well as methods we can use to stack the odds of success in our favor. First, we'll learn a little bit about market history, applying some proven strategies that have worked over time, and then actually get to a point where we build a portfolio you can use in today's economy. So first, related to timing the market, can you beat the market? And one of the things we face on a daily basis is the onslaught from the media telling us to buy, sell, things like that. In 1979, Business Week ran this publication that said equities were dead. The 1970s were a hellacious decade for equities, and this publication was telling you not to bother with equities anymore, just sell them. If you had listened to this forecast, you would have missed a fantastic 1,337% run over the next 20 years in the stock market. So be very wary when listening to market forecasts. Again, related to timing the market, over a 20-year period from 1994 to 2013, it was shown that the S&P 500, which is the best gauge for the stock market performance, returned 9.2%. If you had missed the top 20 days during that 20-year period, your return would have dropped to 3%. That's a 2/3 reduction in simply missing the top 20 best days. Not every year, but over the course of that 20-year period. Markets are efficient. On a daily basis, you have good news and bad news fighting with each other, and buyers and sellers. Literally, on a daily basis, you have trillions of dollars determining the value of everything, from currencies to interest rates to stock prices. For someone to say that a security is overvalued is really to state that the entirety of the world is wrong at determining the price of something. Now, tomorrow, if news comes out that's bad, perhaps the value of that entity falls. But that's new information. In general, markets are efficient. And this is a great example. If you had a team that was 5-0 playing a team that was 0-5, it would be reasonable to assume that the stronger team would win. But who's going to beat the point spread? And that's really what the market is a point spread. Ironically, in only 53% of the time, 53% of the time in 45 Super Bowls, the favorite wins. The favorite wins 48% of the time in NFL games and 49% of the time in NBA games in terms of beating the spread. So the market is very efficient at pricing winners and losers. Dollar cost averaging is the concept of buying throughout the course of a market cycle or as prices fluctuate up and down. We like this graph, however, because it really speaks to the emotional side of investing. Imagine a market that's rising and there's optimism and excitement and the thrill, and then ultimately euphoria. The irony is when you have strong markets, that's the point of maximum financial risk. And conversely, when markets are falling and there's fear, desperation, panic, even despondency, it's when markets are low, that's the point of maximum financial opportunity. And so over the course of our lifetimes, we're going to ride this emotional roller coaster. And one discipline is simply to be investing consistently over time. And this is a great example. So here's a scenario where someone's investing $100 a month each and every month, regardless of where the market is. And so here's an example where the market is at a peak and an example where the market is at a valley. The irony is that this peak is lower than this valley. And so we want to just continuously invest throughout the various cycles. Knowing your time horizon is hugely important. Looking at the stock market, over roughly a 90-year period. If you had a 1-year time horizon, the worst 1-year period in history was a negative 43%, and the best 1-year period was 54%. Literally a 77% differential from best to worst. If you're investing over the course of 1 year and your time horizon is only 1 year, it's very, very difficult to predict where the markets will go. If your time horizon is much longer, say 10 or 20 years, your returns become far more predictable. The worst 10-year period in history had a negative 1.5% return roughly, and the best a plus 20%. On average, you're going to be around the 9 or 10% average return. Keep in mind, even if you were 10 years from retirement or in retirement, your life expectancy at that juncture is very likely 20 plus years. Staying invested over the course of market cycles is very important. As you look at the various colors, blue indicates a 1-year scenario, this gold or yellow is 3 years, and green is 5 years. This slide shows the performance of the markets over or after various crises in the markets. So let's look at the terrorist attacks of 2001. 1 year after the attacks, the markets were down 3%. 3 years later, up 42%. 5 years later, up 84%. A recent crisis, the credit crisis of 2008, the markets were positive a year later, 3 years later, and up 44% 5 years later. People will tell us, this is good information, but this time it's different. The next crisis around the corner will be different. The reality is, each crisis is unique, but the market's response to that crisis is the same. Eventually, the markets work their way through all down markets. And this is interesting, some interesting statistics since the end of World War II. It indicates when the markets have been down 5 to 10%, we've had 77 instances of that. The average decline has been 6%. It took 1 month for that decline to occur, and it took an average of 1 month to recover. If we focus on instances where the market's been down between 20 and 40%, that's happened 8 times since World War II. It was a 27% average decline. It took an average of 11 months for that decline to materialize, and it took 14 months, a little more than 1 year, to recover from that decline. So these are some good statistics to help us through some of the down markets. Here's one of our key proofs looking at the history of the markets. We went back to the 1920s and invested $1 into various asset classes. This light blue line is small cap stocks. The darker line is large cap. The yellow are bonds. The green would be money market assets. And this last line is inflation. And the key takeaway, it's really a market proof, is that small caps do better than large caps, which do better than bonds, which do better than equity or cash, which does better than inflation. This is something over a long period of time that you can rely on. But we frequently hear that equities are risky. The irony is that since the 1920s, equities have been positive 75% of the time. In other words, if you went to Las Vegas and placed a bet and you had a 75% chance of winning, would you do that? And the answer is absolutely. And so to look at the graph a little bit differently, this looks at the years when the market was up between 0 and 10%. It lists the year and the rate of return, up between 10 and 20, and so on. From our experience, people, when they say they can handle risk, they can handle roughly a 10% decline. If we were to include this first red column in with the other blue columns, there'd be an 84% chance that you would not lose more than 10%. So it's really 16% of the time that we have to worry about losing more than a 10% return. Pretty good probabilities when you think about it. This is a periodic table. To help you understand it, we have various years here, starting in 2003. Each color is a different type of asset class. and we list each year the top performing asset class at the top and the worst performing asset class at the bottom. If I could have you simply focus on red, which happens to be an international category, you can see that international was at the top performing category for 5 years in a row. Frequently, clients will suggest, why don't we just own more red? And the reality is, eventually we'll hit a cycle where that category is at the lower end of the performance in future years. And so it's very important as you're investing your money that you have components of all of these different asset classes. So even in bad years like 2008, where bonds were positive, money market was positive, but everything else was negative, it's important that we have a little bit of everything. Rebalancing is a discipline that adds value over time. Rebalancing is the concept of selling some of your winning securities each year and buying some of the securities that have lagged. By doing that, we can actually lower your risk and enhance your returns. Let's take a look. Here's a 40-plus year period of time, and it shows a portfolio in blue that's never been rebalanced versus one in purple that's rebalanced once a year. You can see, looking at risk, the portfolio that's never been rebalanced has a higher risk level than the one that's rebalanced each year. And conversely, looking at returns, the portfolio that's been rebalanced has a higher rate of return. This is as much of a silver bullet as we can provide clients in enhancing returns, is this concept each and every year of rebalancing your portfolio. And this is a great example. Here's an example where you start out with a portfolio with blue being equities. 60% of your money's in equities, and yellow is bonds, 40% roughly in bonds. If we started in 2007, right before the credit crisis, you can see invariably as the stock market fell, by the February of 2009, your portfolio would only have 40% in equities and 60% in bonds. If you didn't rebalance, by the time the market started to recover in early 2009, your portfolio is at a disadvantage. You have less equities than your target levels would indicate you should have. Conversely, if you started with a 60-40 portfolio in 2009 and didn't rebalance, as the market grew, by the end of 2013, you'd have almost 80% of your portfolio in equities, which would potentially be higher than your risk tolerance. So it's important as the markets are falling that we're buying more of the equities, and as markets are rising, we'll actually be selling some of your equities. Asset allocation is the concept, much like baking a cake, is what percentage of your portfolio should you have in various ingredients or asset classes. An asset class would be something like stocks, bonds, international investments, real estate, money market assets, and so on. And a study determined that over the course of your lifetime, the number one factor that determines your ultimate rate of return is a function of your asset class selection. How much do you have in each category? Which stocks you have or bonds is really not relevant, and timing the market is totally irrelevant. So we really want to focus in on how much should you have in stocks and bonds at this point in time. This may look a little bit complicated, but let me help you understand it. This is the efficient frontier. We have risk on the horizontal, and we have return on the vertical. And each asset class has their respective risk and return trade-off. Orange would be a portfolio that's all in bonds. Blue would be a portfolio that's all in equities. So it makes sense that if an all-equity account would have a higher return than bonds, it would also have a higher risk level than bonds. But here's the magic. Bonds still have risk. As you add some level of stocks to the portfolio, you can enhance your return and reduce your risk. Why? Because of what's called correlation. Stocks and bonds act differently. And because of that different correlation, if you blend them together properly, you can have a portfolio that will give you a much higher rate of return with a similar risk level to an all bond account. There's certain factors that have been proven to work over time. And so one of them we've talked about. It relates to the size of your investments. And so here we have a period of over 90 years, or roughly 90 years, where small cap stocks returned a 12% return in the United States, and large caps did 9.8%. So we've proven that small caps do better than large. That theory works in the foreign markets, and it works by an even bigger degree where small caps outperform foreign large caps. And if we took that proof, that theory, into the emerging market, it still works, or it works again. So we've proven small caps do better than large caps. Another proof is that value stocks do better than growth stocks. So let's step back. What's a value stock? Value companies tend to be more established companies like Kimberly-Clark, Procter & Gamble, Pepsi, companies like that, Nike. Growth companies would be faster growing, newer companies like Google or Amazon or a biotech company. Surprisingly, value companies have done substantially better than growth companies over time, more than a 3.5% differential. That theory worked in the foreign markets, and it worked in the emerging markets. And then the last proof is that companies that have high, strong profitability outperform companies that have lesser profitability. That seems intuitive, but it is a key proof, and that proof works in foreign markets and emerging markets as well. So building a portfolio, you really want to focus on smaller companies of value that have profits. Small cap value profits. You're not going to own all of that, but it's a great way to tilt your portfolio in your favor. The theories we just talked about work most of the time, but they don't work all of the time. So let's look at this second one here that compares small caps to large caps. When you see the blue, that indicates where the theory worked. When you see red, that indicates years where the theory did not work. Most of the time, though, it works. In every graph, you'll note when the theory works, it works by a really strong margin. And when it doesn't work, it misses by just a modest amount. So the peaks are much higher than the depths of the valley. Value beats growth most of the time, but not all of the time. You might have 3 or 4 years in a row where growth actually does better. As a result, we're going to continue to own large cap stocks. We'll continue to own some growth stocks, even some bonds or money market assets. So now it's time to buy some securities. And most people say, this is great information. Let me just go buy the S&P 500. We strongly encourage against that. The S&P 500 and many other indices are cap weighted. What does that mean? Market cap, or the size of the company, determines how much of the index you own. Well, remember, value companies do better than growth. What you end up here in the S&P or any cap-weighted index is you end up owning more of the growth or overvalued stocks, if you will. And so the way around that is, instead of determining the size of the weightings inside your funds by market cap, let's look at some other factors, smart factors: price to sales, price to cash flow, price to book, price to dividends, to determine what percentage each security gets within the fund. And here's an example of the benefits. Again, we have risk on the horizontal, return on the vertical. We can take the S&P 500, the same 500 stocks, and re-weight them based on some fundamental factors, and we can actually increase your return and reduce your risk. That same strategy works in the international markets, the small cap markets. And here in the emerging markets, your return is boosted significantly with just a modest increase in risk. So fundamentally, weighting a portfolio versus cap weighting is a much better strategy. So there's some core tenets that we follow. Asset allocation and diversification is paramount. We look at these empirical proofs. Stocks outperform bonds, small caps outperform large caps, and so on, to tilt your portfolio towards success. We want to be tax efficient, favoring exchange-traded funds instead of the less efficient mutual funds to control your taxes. When you do have losses, we want to harvest those right away rather than waiting. We favor lower cost funds. Lower is better, but the lowest isn't always the best. We want to look at value of the fund and the value add it can provide. And then investment disciplines, rebalance, dollar cost average, and then planning for income accordingly within a portfolio. So these are some of the core tenets that will facilitate the management of a well-run portfolio. That's the end of our presentation. If you have any questions, feel free to give us a call. Shakespeare Wealth Management, 262-814-1600. Thanks for listening.